Hello everybody, this is Lara with your end of the week video for gold for the trading week ending Friday 30th of August. At the end of the week, it looks increasingly likely that there's a major high in place. The upwards trend reached very extreme and overbought, and now we've got candlestick reversal patterns at both daily and weekly chart levels. The bullish wave count expects a big consolidation to find support at about 1469. The bearish wave count expects a new downward wave to last 1 to several years may have begun. And I have various price points but as price breaches each point, we can have increasing confidence in this wave count. I am still publishing the bearish Elliott wave count first because it still has a much better fit in terms of Elliott wave. The bullish wave count still suffers from a very serious problem in terms of Elliott wave. We'll get to that next. The bearish wave count sees gold still in a bear market as a huge zigzag to subdivide 5, 3, 5. And the B wave at supercycle degree could have been over this week. But in order to have confidence, we do still need to see these price points passed. This is an extremely bearish outlook. It is a possibility, but for the short to mid-term, the bullish outlook is also possible. As each price point giving us confidence is passed, then we can eliminate alternates, and full and final confidence in this wave count can be had with a new low below the full confidence point, because that would finally invalidate the bullish wave count. The structure here of supercycle B is the double zigzag. They're pretty common corrective structures. The first zigzag in the double subdivides 5, 3, 5, and it's labeled cycle wave W. The double is joined by a corrective structure in the opposite direction labeled X, which subdivides very well as a regular contracting triangle. That's the most common type of triangle. Although X waves are almost always single zigzags, they can be any corrective structure. This is the only part of this wave count that doesn't follow the most common pattern, but there's no problems here in terms of subdivisions. Cycle wave Y may now be a complete corrective structure, subdividing 5, 3, 5, and it's achieved its purpose to deepen the correction and move substantially above the end of cycle wave W. We could have seen a major trend change this week. If that's the case, then at the daily chart level, this low here, this point here, here's the structure of cycle wave Y, 5, 3, 5, or A, B, C, subdividing as a zigzag. C now fits beautifully, 1, 2, 3, 4, 5. This wave count could have further confidence if we see a break below the best fit channel, which is drawn across these lows, then with a parallel copy on this high. If we see a full daily candlestick below and not touching this trend line, I'll have some reasonable confidence in this wave count. The first confidence point here is the start of intermediate wave 5. A new low below this price point could not be a second wave correction within intermediate 5, and so at that stage, intermediate 5 would have to be over because we can't see it continuing with 1, 2, 3, 4, 5. So that's the first confidence point. The second confidence point is the high of intermediate wave 1. A new low below this point couldn't be a continuation of intermediate wave 4 within intermediate wave 1. I'm sorry, that's not right. The second confidence point is the start of primary wave C, which gives further confidence. A new low below this point could not be a second wave correction within primary wave C. We couldn't move the degree of labeling here down 1 and see this as intermediate 1 and then intermediate 2, because 2 can't move beyond the start of 1. And so a new low below that point would provide quite a lot of confidence that primary wave C should be over, which means cycle Y and supercycle B should also be over. And full and final confidence would come with a new low below this point by any amount at any time frame, because at that point the bullish wave count would be invalidated. Let's look at the first hourly chart where intermediate 4 will be off to the left of the chart. I'm going to look from this high here. this point here. Within the new downward trend, we have to see a 5-wave structure unfold lower if there's been a major trend change. 1 is now off to the left of the chart. Here's 2. We then need to see 3, 4, 5. I'll label the first 5 down at minor degree. It would be incomplete. Within minute 3, we may have minuet 1. Minuet 2 may continue a little higher, close to the 0.618 ratio. And then 3, 4, 5 may continue next week. Minuet 2 may not move beyond the start of 1 above the invalidation point. At the hourly chart level, if we move the degree of labelling within intermediate wave 5 up 1 degree, and the last high for gold, if we see that just as minor 1, then minor wave 2 may be continuing, and then we may have 3, 4, 5. We could still see a continuation of intermediate wave 5 as it finally comes to an end. The target remains the same for primary C to reach equality in length with primary A. For the short term, the structure of minor 2 would need to complete lower. If it's a double zigzag, here's X, and the second zigzag, 5, 3, 5, would need to continue lower. At the weekly chart level, this is a bullish wave count for oil. It sees the possibility not for oil, for gold. It sees the possibility that gold had a major trend change down here in the end of the bear market. If that's the case, then for gold, if you see any kind of bullish Elliott wave count, you have to resolve the problem of this movement not fitting very well at all as a 5-wave structure. It fits really well as a 3, but when you try and see it as a 5, you've got this disproportionate 4th wave to its counterpart 2nd wave. The 2nd wave lasts just 2 weeks, whereas the 4th wave lasts 12 weeks and covers a much, much greater distance in terms of price. Now, 2nd and 4th waves being disproportionate is not a problem for gold if it's the other way around. There are 2 examples on this chart. Here's an impulse where the 2nd wave is deep and time consuming. The 4th wave is brief and shallow. Here's another one. The 2nd wave is deep and time consuming. The 4th wave is brief and shallow, and it can happen the other way around for a bullish move as well, equally. But here it's the other way around, and this is extremely unusual behaviour for this market. Of all of the markets I've ever done Elliott Wave analysis on, I quite like gold because it's got such enormous volume. The volume tends to give it better looking Elliott Wave structures and makes Elliott Wave just a little bit, I won't say easier, but less challenging for this particular market. And this market has some particular tendencies that it almost always follows. Typical of commodities, it will exhibit swift, strong 5th waves, and when it exhibits that tendency, which is especially prevalent for 5th waves to end 3rd waves 1 degree higher, as this 5th wave in here ends minor 3, that forces the 4th wave that comes just before in here and just after to be more brief and shallow than they otherwise would be. It gives gold's 5-wave impulses a bit of a 3-wave look at higher time frames, a curved look to it. It's extremely unusual to see that happen the other way round, and so this still substantially reduces the probability of this wave count. And if you're looking at any other Elliott wave work and you're looking at a bullish wave count, you have to ask yourself, how has this problem been resolved? It's my assertion, I'll be as strong as to make it an assertion, that it can't be resolved. It is a problem, reducing the probability of this wave count. However, low probability does not mean no probability. If your own personal analysis of this market with the techniques that you prefer to use gives you a bullish outcome, then you may choose to use this Elliott wave count. The target for cycle 3 is for it to reach the most common Fibonacci ratio to cycle 1. Cycle 3 has moved beyond the end of 1. It has to stay far enough above that point to allow cycle 4 to unfold and remain above first wave price territory. Cycle 3 may only subdivide as an impulse. There may be primary 1 and 2, and now primary 3 could be complete. Primary 4 may be continuing further as an expanded flat, which can't move into primary 1 price territory below this invalidation point. Here's a really good example of what an expanded flat looks like. They subdivide 3, 3, 5. The B wave moves beyond the start of the A wave, and then the C wave moves reasonably beyond the end of the A wave. Expanded flats are sideways consolidations in an ever-expanding range, the opposite of triangles, which are a sideways consolidation in an ever-decreasing range. Let's take a look at this possible expanded flat at the daily chart level, where the high for primary 3 is this point up here. Primary 4 may be unfolding as an expanded flat to subdivide 3, 3, 5. Intermediate C is expected to move below the end of A. It may take primary 4 down back into intermediate 4 price territory if it gets particularly deep, or if it's particularly time consuming, it may find support at the lower edge of this Elliott channel. This is an important channel. Draw it from 1 to 3, place a parallel copy on 2 that actually needs to be pushed up very slightly. The lower edge of the Elliott channel might show where primary 4 finds support. If price breaks cleanly through and strongly through this channel, and we see it breached by at least a full daily candlestick below and not touching that trend line, that would add confidence to the bearish Elliott wave count. Primary 4 may not move into primary 1 price territory. Primary wave 3 is a complete structure. It's moved far enough above the end of primary 1 to now label it complete. For this wave count, I will not allow any overlap of primary waves 4 and 1 because the data I'm using to calculate this is cash data. And so we can allow for some overlap occasionally with futures market data. This is not futures data, this is cash data. And so this invalidation point is absolute. A new low by any amount at any time frame, that means even a fraction of a cent on a tick chart, it's that absolute, would firmly invalidate the bullish Elliott wave count. At the hourly chart level, this wave count has to see intermediate C as a 5-wave structure. 1 is off to the left of the chart, here's 2, minor 3 needs to subdivide as a 5, 1, 2, 3, 4, 5. 2 may not move beyond the start of 1. The structure here of 2 is seen as an expanded flat, 3, 3, 5. I've tried to see different ways of labeling this, and I've concluded it's an incomplete expanded flat. I tried to look at it as a combination, possibly complete here, it just wouldn't fit. I've concluded it's probably going to move a little bit further sideways and higher. Let's take a look at classic analysis. At the end of the week for gold, it's been in a strong bull market. It's had some really strong upward movement, but this week we've got a bearish candlestick reversal pattern. This upward trend at the weekly chart level now is very extreme. Very extreme is when the black ADX line reaches above both directional lines and at the same time also above 45. Those conditions are now met. ADX is now very extreme. RSI is overbought, as is stochastics. When a trend reaches very extreme and indicators are also extreme, look out for candlestick reversal patterns and take them seriously. This is why that bearish wave count and the bullish wave count are both expecting some downward movement for the next few weeks. Possibly a big consolidation, that's what the bullish wave count expects, or a major trend change, that's what the bearish wave count expects. This dark cloud cover has a little support from volume pushing price lower within the week, within the red candlestick, and it's got a bearish long upper wick. On balance volume is constrained. The last signal was bullish, that's negated. It was a really weak signal anyway, because this trend line really has too strong a slope for any reasonable technical significance. ATR shows that once price broke through resistance, energy was released and the upward trend has strength. We've been over stochastics and RSI. MACD full bull bullish, that also is a lagging indicator. At the daily chart level, we also, at the last high early in the week, have a candlestick reversal pattern. This is a shooting star with a nice long upper wick. So we have candlestick reversal patterns at daily and weekly chart levels. ADX with a prior upward trend has reached did manage to reach very extreme at both time frames now. RSI reached extreme at the daily chart level and then exhibited triple bearish divergence. It's all lining up to tell us to expect either a big consolidation or a major trend change here. There's been a series of higher highs and higher lows for several weeks, or for months now actually, for gold. Here's the last swing low, or if we want to be more conservative, we could take this one. If we see a new swing low below this price point here, then we can have more confidence in the potential idea of a trend change. But it won't tell us if it's a major trend change in terms of a huge new downward trend or just a really big time-consuming consolidation to last several weeks within an ongoing upward trend. Elliott Wave is going to be most helpful there, and I've given you those very clear confidence points with that final price point 1346 to tell us which of those two scenarios may be happening in coming weeks. On-balance volume at the daily chart level gives us a bearish signal. This trend line only had 2 anchor points here before it was breached. It was only tested probably once here. The signal isn't very strong, somewhat reasonable, but it is a bearish signal. There is some strength within the downward movement as well within the week. We've been over 80x. It's now declining, telling us that there may be no trend at this stage, at this time frame. ATR is declining as price is moving sideways. Stochastic's back into neutral territory, and MACD's been giving us some whipsaws. Currently, it's had a bearish crossover. That's all from me this week with your gold analysis. I hope all of our members are having a most awesome weekend.